Hello there, my name is Michelle, your tax advisor from TXTK Tax Tech. Welcome back to our course series of UAE corporate income tax. In our previous video, we discussed what corporate income tax is, how it has transformed business in the UAE, and the importance of proper bookkeeping. In today's video, we'll dive deeper into the topics of taxable profit, cost, and expenses. First, let's talk about taxable profit and how it is calculated. You've probably heard that corporate income tax rate is 9% of net profit. But that's not entirely accurate. Corporate income tax is 9% of taxable profit. So, what's the difference between taxable profit and net profit? Taxable profit is actually derived from your net profit. The net profit is essentially your company's income minus direct costs, operating expenses, and annual depreciation expense. However, some expenses as defined by the tax law cannot be fully considered operational costs. In such cases, we need to add back the extra expenses we deducted from net profit to arrive at the taxable profit. For example, tax regulations stipulate that entertainment expense incurred by a company can only be 50% deductible for tax purposes. But when calculating net profit, we deduct 100% of the entertainment expense. This is where we need to add back the 50% we over-deducted to arrive at the taxable profit. As a result, taxable profit is actually higher than the real net profit in this case. Let me give you another example. If a company has sales revenue of 1 million AED and the total cost and expense is 600,000 AED, including 100,000 AED of entertainment expense, the initial calculation indicates that the net profit is 400,000 AED. However, since only 50% of the entertainment expenses are deductible for income tax purpose, we need to add back half of this entertainment expense, which is 50,000 AED, to arrive at a taxable profit of 450,000 AED. Corporate income tax rate is 9% of this taxable profit. If we are not aware of the difference between taxable profit versus net profit and calculate corporate income tax based on the net profit, we could underpay the tax, which leads to potential penalties. Next, let's talk about cost. Costs can be broadly categorized into three types: direct cost, operating expenses, and non-deductible expenses. First, let's talk about direct cost. Direct costs are costs or expenses directly related to the production or procurement of goods and services. Raw materials for a factory, inventory acquired by a trading company, or even research and development expenses for a software company. In our previous video, we have shown you how to record these costs in Mirage books. Today, we are diving into a specific scenario: how to handle the cost of imported goods and what financial documents you should keep. When importing goods into the UAE, there is a 5% customs duty. This duty is calculated based on the declared value of the goods. In the past, some companies would understate the value to reduce customs duty. However, with corporate income tax in place, underreporting the value can lead to inflated profits, which could lead to a higher income tax. So we should record these costs accurately. But how? Let's log on Mirage Books app and go to homepage. Click on the plus sign and select Bill Invoice. Enter the transaction date and supplier's name. Under Account category, choose Costs of Goods. Then, manually input the actual purchase cost. Click Attach Files to upload invoices, packing slips, and other shipping documents provided by your overseas supplier. This ensures your company's direct cost is accurate. Now, let's talk about operating expenses. These are the expenditure incurred wholly and exclusively for the purpose of your business. Now, here's a key point. When it comes to corporate income tax, only expenditures directly linked to business operations can be deducted. Personal expenses like your child's tuition, beauty salon membership, or personal shopping, these expenses cannot be deducted for income tax purpose. What about company vehicles? If these vehicles are used for business purpose, such as employee transportation or inventory deliveries, yes, you can include their depreciation in your operating expense. There is another scenario. If you buy a vehicle as a company asset and it makes money, like through rentals or sales, you can count its depreciation as an operating expense. This is true even if the vehicle isn't used every day for your business operations. However, real estate, such as property and land, cannot undergo depreciation. These assets stay on your company's balance sheet as long-term fixed assets. While using your company's name to acquire property might not offer immediate tax benefits, but it can enhance your company's overall value, especially if you own multiple assets. Here's a useful tax tip. Shareholders can give themselves a monthly salary, which can be categorized as an operating expense. While it's not about converting all the profits into salaries, it's a recommended practice. For instance, Oman has set a maximum monthly shareholder salary of 20,000 AED as a reference point. But keep in mind that future tax regulations may offer more guidance on this matter. So, what expenses are non-deductible? Let's go through some common types of non-deductible expenses together. First one, bribery payments. These often involve commissions to suppliers, kickbacks to clients, or payments to government officials. Next, non-deductible personal consultancy or referral fees. Let's say you hired some freelancers, but these individuals cannot issue official invoices to you. Then you have no way to prove the payments to them are your operating expenses. There is a solution. The freelancer can set up a company with a freelancer license, enabling them to issue valid invoices to you. By doing so, you can classify payments to these individuals as part of your operating expense. Additionally, if this freelance company's annual revenue remains below AED 3 million, it becomes eligible for SME tax exemption. Moving on, penalties and donations are generally non-deductible. However, donations to government-registered charities can be considered operating costs. You can easily find these organizations on the tax authority's website. Now, let's clarify something that often causes confusion: the VAT, value-added tax, versus corporate income tax. When we calculate corporate income tax, we use the revenue without VAT. VAT is a separate 5% tax collected by the government. It's not part of your revenue. When subtracting expenses, we deduct cost without VAT. But sometimes you can deduct VAT for certain expenses. In these cases, both the cost and the VAT count as the total operational cost. For example, if you spend 210 AED on fuel, with 200 AED as fuel cost and 10 AED as value-added tax, since you cannot deduct VAT for fuel expense, the operational cost is 210 AED here. On the other hand, if you purchase office supplies for 200 AED with the 10 AED as VAT, since you can deduct VAT for office supply expenses, the operational cost here is 200 AED. Next, let's talk about shareholders' dividends and profits. These are non-deductible expenditures as well. They were paid out after corporate income tax. Even though it's a company money, it's not a business cost. Lastly, any expense that is not entirely related to the company's operation cannot be qualified as operational cost and hence non-deductible. That wraps up today's video. If you have any questions, please contact us or leave a comment below. Also, don't forget to hit like and subscribe to our channel for more information on UAE tax. Thanks for watching.